So picture this, you are at a fancy Wall Street party and you overhear a group of hedge fund managers whispering about their secret weapon for wealth. Intrigued? Well, I'm about to let you in on that secret, and it's not what you think it is. Because professional Wall Street traders work 80 hours a week to try to beat the S&P 500. And do you know that 90% of them fail? And do you know what the most important part is? You don't need a finance degree to build wealth. You just need the right information and the courage to act on it. What if I told you that the key to lifelong wealth is hiding in plain sight? Hi, I'm Maurice, and after 15 years in the financial industry, I'm about to share secrets that overpaid professional asset managers don't want you to know. I'm pulling back the curtain on the one investment that could set you up for life. So in this video, you will learn why high fees are killing your returns and how to avoid them, and the power of S&P ETFs for long-term wealth building. So today we are ranking the best S&P 500 ETFs for lifelong investing, and I will show you how to do it yourself. But first, let me introduce you to someone special. A beautiful proof of the effect of the expensive industry making it too complicated was provided by my client Sarah. Last year, she was drowning in the sea of the financial world, watching her hard-earned money barely keep up with inflation. Sound familiar? Sarah was ready to throw in the towel when she stumbled upon a YouTube video that changed everything. In that video, it was one of mine. So, like many of you, she was overwhelmed by investing options and fears making mistakes and lose a great part of her money, right? And like Sarah, you are not alone, and I'm here to guide you through the journey. So Sarah came to me with a common problem. She was paying high fees for actively managed funds. So I had to break it down to her easy without too much complicated information. So I told Sarah, here is something those fancy fund managers won't tell you. Every dollar you spend on fees is like a dollar out of your pocket. It's like having a hole in your wallet. The bigger the hole is, the less money you keep. It's really easy. But the most important part is this. There is a direct correlation between cost and performance when you talk about asset management. Imagine you are in a race, but you are carrying a heavy backpack. That's what high fees do to your investments. The lighter your load, the faster you will reach your financial goals. So after Sarah understood the impact fees could have on her long-term wealth, we went further. So she asked me if she doesn't need a complex strategy to beat the market. And this is a common misconception that the industry is telling you. You will be amazed at what's possible when you bring disciplined investing into your life. Actually, keeping it simple and diversified is often the best approach. That's where the S&P 500 funds come in. They offer instant diversification across 500 of America's top companies. However, the key element to focus on is this. Let's break down what these S&P 500 ETFs actually invest in. The S&P 500 tracks 500 of the largest publicly traded companies in the United States. This means when you invest in the S&P 500 ETF, you are buying a small piece of these big companies. These 500 companies come from various sectors of the economy, including technology, companies like Apple, Microsoft, or Amazon, healthcare like Johnson & Johnson, United Health Group, financials, energy, utilities, real estate, etc. So most S&P 500 ETFs are market cap weighted. This means larger companies make up a bigger portion of the fund. For example, as of 2024, technology giants like Apple, Microsoft, and Amazon often makes up a significant percentage of these ETFs. While these are US companies, many have global operations. So you are getting some international exposure, but through US based corporations. But you always have to remember that a crucial detail here is the composition of the S&P 500 changes over time. Companies can be added or removed based on their market cap and other factors. Your ETF will automatically adjust to these changes. And by investing in an S&P 500 ETF, you are essentially buying a slice of the US economy with a focus on its largest players. This provides broad diversification within the world of large US stocks, which can be a solid foundation for many beginning investors. And in this day and age, You don't need expensive asset managers to build wealth. The power is in your hands. With the click of a button, you can invest in the same market beating index that Wall Street pros struggle to outperform. By choosing low cost S&P 500 funds, you are not just saving money, you are taking control of your financial future. And you will be amazed at how much your wealth can grow when you are not paying hefty fees. And this is how smart investors do it, and now you are one of them. So now let's look at the top contenders that follow the S&P 500 for your lifelong investment journey. So I put up some data for Sarah with three top performing S&P 500 ETFs: the FU, the SPI, and the IVV. So let's break this down. First, we look at the expense ratios, the annual fee you pay. The FU and IVV both charge 0.03%, while SPI charges 0.09%. So that doesn't seem like much of a difference, right? But over decades, it could mean thousands of dollars in your pocket. Now let's look at trading volume. The SPI is the winner here, with massively daily volume. FU and IVV are still very liquid, but not quite as the SPI's level. Let's move on tracking error. Tracking error is a concept primarily used in investing, particularly when discussing ETFs. Here is a simple explanation of the tracking error. Many funds aim to replicate the performance of a specific market index like the S&P 500. It's typically expressed as a percentage. A lower tracking error means the fund is closely following its index. So these three funds are all impressively below 0.01%. And these can change, but they're usually very close. And then the dividend yield compared. The FU at 1.43%, the SPI at 1.42%, and the IVV at 1.47%. A nice bonus for holding these long-term ETFs, right? So then we look at fund sizes. FU at about $1.1 trillion, SPY around 533 billion, and IVV at approximately 487 billion. All are massive and extremely stable. And then the most important part, the 10-year performance. FU at a 12.43%, SPY at 12.38%, and IVV at 12.42% average annual returns. So they are really close, right? So how do you choose? I told Sarah they are all excellent choices, but if I had to rank them, FU at number one with lowest fees, good liquidity, and Vanguard's excellent reputation. Number two is the IVV, matches FU on fees, slightly higher dividend yield. And number three is the SPI, highest liquidity but also the highest fees. So for most long investors like yourself, FU or IVV would be my top picks. The lower fees will add up significantly over a lifetime of investing. And what happened next was truly unbelievable. Sarah, her financial stress disappeared as her wealth steadily increased by following this simple advice. So you are now equipped to invest like a pro without a hefty fees. But before we wrap up, there's one more secret I need to share. While the S&P 500 is a fantastic start, it's not as diversified as you might think. A significant portion is in the tech industry. So if you want true diversification, you will need to look beyond just the S&P 500. So in our next video, we will explore global diversification strategies that can take your investments to the next level. And this is a really important part. Remember, your financial future is in your hands. And now you have the knowledge to make it bright. By understanding and applying these S&P 500 investment strategies, you are taking control of your financial future in a way most people never do.